Have you ever stopped to wonder why a huge company, like an Apple or maybe a Walmart, would spend millions, sometimes even billions of dollars buying back its own stock? It seems a bit weird, right? Kind of counterintuitive. Why buy something you basically already created? Well, there's an accounting term for this: treasury stock. And today, on the deep dive, that's our mission. We're going to unpack this whole idea. We'll go beyond just like the basic definition and dig into the real strategic reasons companies do this. And really importantly, we'll look at how accountants actually record these moves on the company's books. We'll use some solid examples, real numbers to make it super clear. But before we jump right in, just a quick reminder, this deep dive draws heavily on material from Farhat lectures. All the content, the examples, the explanations we're discussing today, they're derived from the great accounting resources over at farhatlectures.com. So whether you're maybe an accounting student prepping for the CPA exam or already a professional, you should definitely check out the website. They've got extra practice questions, video lectures, tons of support to help reinforce what we talk about today. A big thank you to Professor Farhat for providing this valuable material. Okay, so let's unpack this treasury stock thing. Buying back your own shares. It is definitely not random. It's usually a very calculated, strategic decision. There are often several key goals behind it. It's not just about shifting numbers around on a spreadsheet.
Absolutely. And what's really interesting, I think, is that these aren't just, little accounting quirks. They're often significant business decisions. They reflect strategy, market conditions, maybe even management confidence. So yeah, we really need to understand the why before we can properly grasp the how of the accounting side. Okay, so one of the biggest reasons, probably the most common one you hear about, is to increase earnings per share, or EPS. Now, EPS, as you probably know, is a key metric for investors. It's simply the company's net income divided by the number of its shares that are out there, the outstanding shares. Tells you how much profit is behind each share.
Right, profit per share. Makes sense.
Exactly. So how do buybacks boost this? Let's take a simple example. Say a company makes $100,000 in net income and has 100,000 shares outstanding. Their EPS is easy math, $1 per share, $100,000. 100,000 shares. Now, let's say they go out and buy back half their shares of 50,000 shares. Now there are only 50,000 shares left outstanding. Even if their net income stays exactly the same at $100,000, suddenly their EPS jumps to $2 per share, 100,000, 50,000 shares.
Wow, okay. So just by reducing the number of shares, the profitability per share looks like it doubled.
Precisely. And that sends a pretty powerful signal to the market. It makes the company appear more profitable on that per-share basis, which investors tend to like. It can boost confidence, maybe support the stock price. Sometimes executive pay is even tied to EPS targets, so there's that angle too.
That EPS boost does sound powerful, but I mean, are there criticisms? Like, is it always the best use of company cash? Maybe investing in R&D or something might be better long-term?
That's a really important question, and yeah, it's a major point of debate. If a company is pouring tons of cash into buybacks instead of, say, innovation, new factories, or strategic acquisitions, some critics argue it signals a lack of good internal growth opportunities. They might say it prioritizes, short-term stock bumps over genuine long-term value creation. It's definitely something investors watch out for. Okay, another reason very closely linked to EPS is boosting return on equity, or ROE. ROE is net income divided by total shareholders' equity. Similar logic here. Buying back stock reduces the total equity on the balance sheet.
Ah, okay. So again, shrinking the denominator in that ratio.
Exactly. By reducing the equity base, even with the same net income, the ROE percentage goes up. This suggests the company is generating profit more efficiently with the capital shareholders have invested. Another positive signal, generally. Then there's a more defensive reason, avoiding a hostile takeover, where an outside party tries to buy up enough stock to gain control and maybe kick out the current management team.
Right, like corporate raiders you hear about.
Sort of, yeah. So if management gets wind of a potential hostile bid, they can try to buy back shares themselves from the open market. This reduces the pool of shares available for the hostile bidder to snap up, making it harder and more expensive for them to gain control. It helps existing management consolidate their position.
Interesting. Using the company's own money to protect themselves, essentially.
In a way, yes. Another reason is quite practical, granting stocks to employees. Lots of companies, especially in tech, use stock options or restricted stock units, RSUs, as part of employee compensation or incentives.
Oh, yeah. Stock options are common.
Right. So to actually provide those shares when options are exercised or RSUs vest, the company needs to have shares available. Buying them back from the market, creating treasury stock, is one way to source those shares without issuing brand new ones, which would dilute existing shareholders.
Okay, so it's like building up an inventory of shares for employee plans.
Precisely. And then there's a really smart reason. From a shareholder perspective, rewarding shareholders in a tax-efficient way. When a company actively buys back its shares, that buying pressure tends to push the stock price up, or at least support it.
Okay, basic supply and demand.
Exactly. For the shareholders who don't sell, this rise in stock price creates what's called an unrealized gain. The beauty here is, unlike cash dividends, which are usually taxed right away when you receive them,
Right, you get that 1099 DIV.
yeah, with buybacks, the gain isn't taxed until the shareholder actually sells their shares. So it gives shareholders control over the timing of their tax liability. It's a way to return value without forcing an immediate tax hit.
That's quite clever, actually. Tax deferral.
It is. And one last one, maybe less common for big companies, but still relevant: making a market in the stock. Sometimes, for smaller companies or stocks that don't trade very often, there isn't much liquidity. It can be hard for investors to buy or sell without moving the price significantly.
Like a thin market.
Exactly. So the company itself might step in. They might buy shares when people want to sell, and maybe sell some of their treasury shares when people want to buy. They act like a sort of market maker, ensuring there's a smoother flow of trading for their stock.
Wow. Okay, so these aren't just minor financial tweaks. These are really powerful strategic tools affecting profitability metrics, ownership, employee compensation, shareholder returns, the whole picture. You've definitely made the why much clearer. So now that we get the strategy, let's switch gears to the how. How do accountants actually put these transactions down on the books? This is where it gets interesting, right?
Yeah.
Especially when they sell the shares back later.
Right. And connecting this back, getting the accounting right for treasury stock is absolutely vital for accurate financial statements. The most common approach we use is called the cost method, and luckily, recording the initial purchase is pretty straightforward. Let's use that Farhat lectures example from the source material. Imagine their equity section looks like this at the start. They've got common stock listed at $1 million. This represents 1 million shares they originally issued. And let's say they had a $1 par value per share. Par value is just a nominal legal amount, often tiny. Then they have additional paid-in capital, or APIC, of $14 million. This is the amount shareholders paid above that $1 par value when the shares were first sold. Maybe they sold them for $15 each, $1 par plus $14 additional. And finally, retained earnings of $500,000, the profits kept in the business. So add all that up. $1 plus $14 plus $70.05 gives you total stockholders' equity of $15,500,000.
Okay, got the starting picture. $15.5 million in equity.
Perfect. Now the transaction. On March 1st, Farhat Lectures decides to buy back 100,000 of its own shares. They pay the market price at that time, which is $10 per share. So the total cost is 100,000 shares times $10 a share, which equals $1 million.
Okay, $1 million cash going out.
Exactly.
Yeah.
So the journal entry is this: we debit or increase an account called Treasury Stock for $1 million. Now, this is key. Treasury Stock is shown in the equity section, but it's a contra-equity account. Think of it like a negative number within equity. It produces total equity. And the other side of the entry, naturally, is we credit or decrease cash for $1 million because the money left the company.
Debit treasury stock, contra equity, reducing equity, credit cash, asset decreasing. Makes sense.
Right, and the immediate impact on the balance sheet. Total stockholders' equity drops instantly by that $1 million paid. So it goes from $15.5 million down to $14.5 million. And importantly, the number of shares issued stays at 1 million, but the number of shares outstanding, those held by the public, drops to 900,000. 1 million issued minus the 100,000 held in Treasury.
Okay, so buying back reduces equity, reduces cash, reduces shares outstanding. Pretty clear. But then what happens when they decide to sell those treasury shares back into the market? You mentioned that's where it gets a bit more complex, especially if the selling price is different from the $10 they paid.
Exactly. This is where you need to pay close attention. How do we handle the accounting when we resell these shares, particularly if the resale price isn't that original $10 cost? The most critical rule to remember here: any difference between the resale price and the cost is never recorded as a gain or loss on the income statement.
Never. Not even if they sell it for way more than they paid.
Never on the income statement. Think about it. The company is dealing in its own stock. These are considered capital transactions adjustments to the company's ownership structure and capital base, not operational profits or losses. Any gain or loss only affects the equity section of the balance sheet.
Okay, that's a fundamental point. Equity impact only.
Right. So let's walk through those scenarios using our Farhat Lectures example, where the cost per treasury share was $10. Scenario 1, reselling above cost. Let's say on March 20th, they sell 10,000 of those treasury shares, and the market price is now $14 per share. First, cash comes in. 10,000 shares, 14 share equals $140,000. So debit cash, $140,000. Next, we need to remove the treasury shares we sold from our books at their original cost. That's 10,000 shares, 10 share equals $100,000. So we credit treasury stock, $100,000, reducing the contra equity balance. Now our debits, $140K, don't equal our credits, $100. We have an excess of $40,000. This difference, this gain, is credited to a specific equity account called paid-in capital from treasury stock.
Ah, okay. So cash goes up 140K, treasury stock goes down, or equity goes up by $100, and this new paid-in capital from treasury stock account gets the 40K difference.
Exactly. That 40K represents additional capital raised from shareholders through these treasury stock transactions. It increases total equity. Scenario 2. Reselling below cost, but we have that buffer. Now fast forward to April 5th. They sell another 10,000 treasury shares, but the market price dipped to $9 per share. Remember, the cost was $10, cash coming in. 10,000 shares, $9 shares, $90,000. Debit cash, $90,000. Remove the shares from treasury stock at cost. 10,000 shares, 10 share equals $100,000. Credit treasury stock, $100,000. Now our credits, 100Ks, are higher than our debits, 90K. We have a $10,000 shortfall or loss on this specific sale. Where does this debit go? First, we check that paid-in capital from treasury stock account. Remember, we put $40,000 in there from the last sale.
Right, I had a 40-guy credit balance.
So we use that buffer first. We debit paid-in capital from treasury stock for $10,000. This absorbs the loss and reduces the balance in that account from $40,000 down to $30,000. Notice it didn't hit retained earnings yet.
Okay, so that paid-in capital account acts like a shock absorber for these losses on resale up to its balance.
Perfectly put. But what if the loss is bigger than the buffer? Scenario 3. Reselling significantly below cost, wiping out the buffer.
Yeah.
Okay, May 1st, another 10,000 shares are sold, but the price is down to $6 per share. Cost is still $10. Cash in, 10,000 shares, 6 years equals $60,000. Debit cash, $60,000. Remove shares at cost. 10,000 shares, 10 shares equals $100,000. Credit treasury stock, $100,000. Now we have a $40,000 shortfall. 100K cost, 60K cash. How do we handle this debit? First, we look at paid-in capital from treasury stock. It only has a $30,000 balance left from scenario 2. So we debit that account for $30,000, wiping it out completely, its balance becomes zero.
Okay, buffer used up. But we still have $10,000 of the shortfall left, 40K total, 30K absorbed.
Exactly. That remaining $10,000 loss must then be debited directly to retained earnings. So the final debit piece is $10,000 to retained earnings, reducing the company's accumulated profits. But again, even though retained earnings is affected, this still isn't an income statement loss. It's purely an equity adjustment reflecting the capital transaction.
Got it. So the order of absorbing losses is first paid-in capital from treasury stock, and only if that runs out, then retained earnings takes the hit, and never, ever the income statement.
You got it. That's the core logic of the cost method for treasury stock resale.
So thinking about the big picture here for you, the listener, really understanding these treasury stock mechanics is pretty vital, isn't it? It lets you see behind the curtain a bit, understand the company's capital management strategies, and how they signal things to the market, even if the accounting seems a little, well, circular sometimes. It's definitely more revealing than just looking at the net income figure.
Absolutely. This deep dive really highlights that tight connection between, high-level business strategy and the nitty-gritty of accounting rules. Managing treasury stock isn't simple, but the accounting provides a clear, structured way to track these complex capital movements impacting common stock, AP, treasury stock itself, and sometimes retained earnings, but always keeping those effects within the equity section separate from operational results.
All right, here's a final thought for you to chew on as we wrap up. When you see a company announce a big share buyback program, how does knowing about this accounting treatment, especially how gains and losses on resale are handled, influence how you might interpret that news? Think about what it signals about their view of their own stock price, their use of cash, and maybe their future growth expectations. Does it make you feel more confident or maybe raise questions? And if you want to dive even deeper into this or other accounting topics, don't forget farhatlectures.com. It's packed with resources, practice problems, video lectures, really everything you need to master concepts like treasury stock. Think of it as a solid investment in your financial knowledge.